You might have gone to an ATM and found the previous customer's receipt. The right thing to do is not to look at the balance. In 2011, someone found a receipt at an ATM. They didn't do the right thing and looked at the balance, which showed about $100 million. That is 13 billion Kenya shillings. People claimed that the account belonged to a hedge fund manager called David Tepper. A hedge fund is simply a complicated investment. David Tepper denied it by saying, "I would never do something as irresponsible as leaving $100 million in a savings account." Listen to find out why this would be irresponsible and what is the right way to use your bank account. In March this year, 3 banks failed in the US. These were Silvergate Bank, Signature Bank, and Silicon Valley Bank. 2 collapsed because they had put too much money in cryptocurrency, and 1 crashed because of a bank run. A bank run is where customers panic and many of them withdraw their money. Of course, this scared people in the US, but it also brought us bad memories of banks that have failed in Kenya. They are bad memories because, can you believe it? Close to 40 banks have failed in Kenya so far. These are some of them. Some had strange names, and it is like when you decide to register a company, but you haven't come up with a name yet. So you make up a few nonsense names on the spot. Without a doubt, over the years, central banks have become better at preventing banks from failing. Like in March, the US authorities acted fast, and at this moment, Silicon Valley Bank is open for business. So, over the years, banks have become safer. But new problems are always coming up, and you must keep yourself from getting caught up in future bank failures. How to keep yourself safe is knowing what to use your bank account for. It seems like a basic thought, but we often forget. First, bank accounts are not meant to be a place for you to stash large sums of money. The first reason is straightforward. Bank accounts pay no or very little interest, meaning whatever money you keep there for a long time is losing value. You might have felt the effect of inflation over the last few months. Day after day, things seem to get more and more expensive. Last year, 1,000 shillings could buy you more petrol than it can today. This is how inflation works. And when you leave your money sitting in a bank account without earning interest, it is just losing value. Large financial organizations such as investment companies know how to ensure that large sums of money earn interest. Investment companies need to keep part of their clients' money as cash. This is because people continuously invest in these companies and withdraw money from them. Sometimes they might have a lot of cash while they wait to invest it. So they will always have large amounts of money ready to serve their clients. To make this money earn interest, they might do something called overnight lending. This is where they lend money to a bank or another financial institution for a few hours and earn returns on that amount. The interest rate is low, but it is an efficient way of using money. As an individual, you cannot do this overnight lending, but you can think of efficient ways of using your money. If for some reason you have a considerable amount of money, it shouldn't stay in the bank for long. If you are still thinking of what to do with it, put it in a fixed deposit account, or better yet, a money market fund. Don't let people use your money for free. The second reason you should not leave a lot of money in your bank account is it is not safe to do so. We all want to keep our money safe, so we put it in banks instead of in our mattresses. This need to protect wealth goes far back in history. One way people used to keep their money safe was to put it in the temples of their gods. Because people in an area worshipped the same god, no one would even imagine robbing the temple. Well, banks are not temples, and when you have a large amount of money, people will try to get to it. A text message makes rounds every once in a while. It is about a code you need to input into your Safaricom number that prevents fraudsters from hijacking your phone number and then hijacking your bank account. Some of the times that people have fell for this scam, people have lost millions of shillings while feeling helpless. But there is another person that you need to watch out for: yourself. You must give your money work to do. Otherwise, you will start spending it like you eat crisps. You keep saying one more won't hurt, and before you know it, you have eaten one of those party-sized bags. Or you might get crazy investment ideas that under normal circumstances you would never consider. So to protect your money from fraudsters and yourself, do not let it sit idle in your account. The best thing I would advise is always to have a list of financial goals that you have given ranks. When you receive money, put it towards your highest priority goal. If you don't have these priorities yet, park the money in several money market funds and start working on that list. Bank failure is another reason you should not put too much money in a bank account, but it is not as common as the two reasons I shared a moment ago. But let me talk about why banks fail, and maybe it might give you an early warning before your bank collapses. You need to keep an eye on three main things when a bank has a lot of your money: capital adequacy, asset quality, and liquidity. I'm going to focus on asset quality because it is affected by capital adequacy and it affects liquidity. Asset quality is basically the type of assets that banks have. The first level of assets include cash on hand and money that the bank has deposited in other banks. A bank usually has currency that it uses for its operation. Cash does not have much risk. Another type of asset that a bank might have is investments. This includes bonds and other financial instruments. These types of assets have more risk than cash. The third type of asset is loans. For a bank, loans are an asset because the bank expects to receive the money back in future. This is the riskiest asset that a bank can have. So, for a bank to be safe, it must be careful when it makes investments and when it gives out loans. The bank can quickly go out of business if it makes significant losses in the investments and gives loans to too many people who cannot pay. Let me give you a step-by-step illustration of how a bank can fail using the example of the three US banks I discussed earlier. All three banks, that is Silvergate Bank, Signature Bank, and Silicon Valley Bank, failed because they had low quality assets. Specifically, the second type of asset, which are investments. Silvergate and Signature had both invested heavily in cryptocurrency. Crypto is volatile, and around the time the two banks crashed, the cryptocurrency market was very volatile. They made losses, and this destroyed their ability to operate. Silicon Valley Bank, on the other hand, did not have cryptocurrency, but it had government bonds. Typically, government bonds are safe, but there are situations where you can make a loss, and Silicon Valley Bank found itself in one of these situations. If you buy a long-term bond that pays 11% interest, your money is safe if you hold it until it matures. If you decide to sell it before it matures and the interest rate in the market is 14%, you must take a loss. People will only buy your 11% bond if you sell it at a discount. This is what happened to Silicon Valley Bank. They sold some bonds at a loss after the government had raised interest rates. So their second level assets, the investments, were low quality. When their clients heard this, many of them withdrew their money at once, resulting in failure at that time. This same thing happened during the financial crisis of 2008, but it involved the loans category of assets. Banks had given mortgages to people who could not pay. They assumed that the value of the houses would keep increasing. When the real estate market crashed, so did the banks because their assets, those loans that they are given out, became worthless. So how can you keep yourself from being caught up in a bank failure? Make sure you are using your bank account the right way. First, your bank account is primarily for paying your bills over the course of a month. You should only have enough money to cover your monthly expenses in the account that you have an ATM or can easily access from your phone. When you receive any extra money, you need to move it out of that account. This will keep you from being tempted to overspend, and also you won't lose much money if fraudsters access your account. Doing this will also help you develop the discipline of always budgeting your money. Second, you can have a portion of your emergency fund in another bank account. An emergency fund is money that you have ready to deal with unexpected events. It could equal 3 to 6 months of your monthly income or spending. So, if you spend $1,000 a month, your 3 months emergency fund would have $3,000. So you would put $1,000 in a savings account in a bank so that it is near. You will then put the $2,000 in a money market fund. Again, if something happens to your account, you might lose part of your emergency fund, but not all of it. Third, steps 1 and 2 are only possible if you have a financial plan. When money starts accumulating in your account, your earnings might be good or your saving habits might be good, but it also means you do not have a plan. This is a sign that you need to sit down with a financial planner, figure out your financial goals, and create an investment plan. You will be surprised at how much you will achieve with that cash you are holding on to. Banks are safer than they have been in the past. This is because of the rules that regulators have put in place. However, if a bank does not pay attention to the investments that it makes and the loans that it gives out, it might fail. For you though, fraud and meager interest rates are why you should not leave a large amount of money in your bank account. Only use your bank account for monthly transactions and holding a portion of your emergency fund. Create a financial plan to invest anything above this. Having a fat bank account can result from years of hard work, but don't risk losing your hard-earned cash by leaving too much of it in an account.